A settled question is the most dangerous position you can hold in the 2026 market. Right now, the consensus assumes that technology giants will indefinitely repeat the massive returns they have delivered over the last 3 years. The largest technology companies are fundamentally exceptional businesses. However, an exceptional business does not guarantee an exceptional stock return. The valuation the market is asking you to pay today has already absorbed the next several years of earnings growth into the current price. To understand a crowded trade, look at the forward return equation. Your return equals what the asset generates, minus the consensus premium. That premium is a toll for owning what everyone wants, a direct subtraction from your actual return. The heavy premium assigned to certainty doesn't disappear gracefully when that certainty describes a temporary market moment rather than a permanent trend. Because that tech consensus is so loud, I am directing capital toward the exact opposite sector: consumer staples. This category has been systematically ignored and starved of capital from 2023 through 2026. These stocks dropped in price due to multiple compression. The underlying businesses did not deteriorate. Capital simply flowed in the other direction. In 2021, a consumer staple traded at a 22 price-to-earnings multiple. Today, it trades at 17. The anomaly? Earnings per share grew 5% annually. A buyer today pays a lower multiple for a significantly larger earnings base. We isolate the targets within this sector using the Dividend Aristocrat filter, companies with 25 consecutive years of annual dividend increases. Buying a growing earnings base at a compressed price allows a new buyer to capture the correction of a consensus-driven mispricing. The valuation derating was driven by the belief that staples are facing a structural decline and losing permanent market share to private label brands. But what the market actually witnessed was volume elasticity during the acute inflationary shocks of 2024 and 2025. Companies raised prices, causing consumer volume to plummet. The market assumed this valley was permanent, but data reveals a divergence. Path A shows structural loss, with consumers switching permanently. Path B shows aristocrats absorbing the shock, volumes recovering fully as brand loyalty reasserted itself. The market mispriced these aristocrats by punishing them for temporary cyclical volume elasticity, missing the empirical proof of their durable pricing power. 25 consecutive years of dividend increases represents empirical proof of capital allocation discipline that survives multiple macro cycles and shifts in consumer behavior. To verify that a company's dividend growth capacity is genuine, we examine its free cash flow margins. This plot tracks free cash flow against payout ratio. On the left, an artificial yield. Margins drop while the payout ratio skyrockets. In contrast, the Aristocrat target funds dividend growth entirely through expanding margins, keeping the payout ratio completely flat and safe. A dividend backed by expanding free cash flow margins through a period of extreme volume pressure invalidates the exact adverse conditions the market used as an excuse to reprice these businesses lower. We can calculate the total return opportunity of this rotation by stacking its 3 distinct mathematical components. Component 1 is the starting yield. Price compression has pushed yields on these staples to 10-year historical highs, sitting between 3 and 4%. A business that was yielding 2.5% 2 years ago and is now yielding 3.5% sees that jump because the entry price plummeted, not because the payout spiked 40%. The second component is dividend and earnings growth, adding 3 to 7% annually. The third is multiple normalization. Moving from 17 to 20 times earnings creates massive independent price return. Compare this stack against tech consensus, where premium drag heavily limits forward potential. Multiple normalization generates massive capital appreciation entirely through market repricing, requiring zero fundamental improvement in the underlying business. This rotation trade does not require consumer staples companies to suddenly become exciting. It only requires mechanical capital reallocation. Macroeconomic catalysts are what trigger this inevitable market rebalancing. Whether technology earnings disappoint relative to expectations, or the rate environment shifts to punish high-duration growth assets, capital eventually acts like water breaching a dam. When the performance differential between tech and value becomes extreme, capital mechanically siphons out of peak multiple tech and flows toward assets trading below their historical averages. The time to enter a rotation is before the capital flow makes the entry price unavailable. By the time the technology consensus quiets down and the market correctly prices this boring alternative, the compressed entry price that makes the math work will already be gone.